Cheung is here to recap the week we have just experienced. Brian?
Well, first and foremost, it's important to recognize that this is a global health emergency and the human impact cannot be understated. But by now, most people already understand the virus and the hygienic precautions that they need to take. But there may be some confusion as to why financial markets appear to be spinning out of control. So this week, we're walking through exactly what happened and trying to create a piece and understanding of exactly why markets are doing what they're doing. So let's take a look at the market sell-off for right now. If I pull up the Dow Jones Industrial Average and I show you a 1-month chart here. Give me a quick second. Again, we're coming off the highs that we had for the day, but I want to show you a 1-month chart where you can see just how precipitous the fall has been since the middle of February. We actually saw the market down as much as 28%. This was yesterday. Again, it's been coming up a little bit since that point in time. But on Wednesday, we entered a bear market, which for those that don't know the definition is 20% down from its most recent high. But then we got a second shock. And on Sunday, we actually saw that there was a falling out in negotiations between Saudi Arabia and Russia that led to an all-out price war, which took crude oil down to about $30 a barrel. Now, all of this, again, started off with the coronavirus. And we want to understand now exactly what are the measurable impacts of the coronavirus. Well, the problem is that it's not that easily measurable. But we know at least so far what are the most vulnerable industries. So first of all, people aren't flying. Disney just shut down their theme parks yesterday. Travel cancellations are hitting hotels and restaurants. I mean, these four industries alone are worth a total of $1.2 trillion of US GDP. If you actually create that as a fraction of the whole economy, that's over 5%. Now, these industries won't necessarily go to zero as a result of this, but with consumer spending representing such a large part of our economy, actually about 70%, what would happen if we even saw a 10% drop in this or a 20% drop? That would shave off a good chunk of our economic growth. But here is actually the more concerning part. So how many people are actually employed by the same four industries? Well, the answer is actually about 17 million, or about 11% of the entire U.S. workforce, just in these four industries. So imagine what would happen then if a good chunk of these businesses then closed down. Well, most workers in these industries do not have the luxury of being able to work from home. Now, I want to emphasize that while we've heard of some anecdotal cases of layoffs, we actually haven't seen the data yet to know if these industries are doing anything dramatic yet. But this underscores why these businesses are being called on to take a hit on the chin, at least for now, and take fewer profits to keep their employees on payroll. At least that's what Treasury Secretary Steven Mnuchin urged this morning. But the question now is what happens if some of the businesses here start to go out of business? Again, worst case scenario. Well, this is a chart from UBS that I want to show you, and this shows what they call high yield spread. Now, high yield generally refers to bonds that are issued by companies with lower credit ratings and higher risk. So the more distressed companies there are out there, the more high yield there's going to be out there in the market. Now, again, this chart shows the spread, which is the difference between what high yield pays in the market compared to other yield instruments. Well, you notice anything? You're going to notice that spike that we've seen in the past few days. That could speak to fewer people wanting to buy that debt. And UBS and Moody's say pessimistic scenarios would actually have these spreads spiking up even further. Now, this chart doesn't show you the financial crisis, but you can imagine that in 2008, you did see high yield spreads spike quite high. So if more companies are issuing debt because they're eating margin to survive, but also at the same time, no one wants to buy their debt, the question is then, will that trigger something to credit markets? Now, there are examples of other so-called liquidity problems like what we're seeing here, namely in the Treasury market. But because of this, in the past week and a half, we've seen the central bank, that's the Federal Reserve here in the United States, step in because they are worried about the impact that it would have on the financial system. Now, the high yield market, again, as I just mentioned, is just one example of what they call financial tightening, and we're seeing it in Treasuries too. Now, it's not necessarily impending doom per se, but it's an area where liquidity may be a problem, which is why the Fed is trying to do what it's doing. So last Tuesday, they abruptly lowered interest rates by 50 basis points to encourage banks to lend to businesses to help them weather the disruptions from the virus. And then this week, the Fed actually ramped up what they call their repurchase or repo operations, which are short-term lending facilities of cash that are available to banks and broker-dealers to temporarily fund positions on their balance sheets. This is called the plumbing of the financial system. And yesterday, they ramped up this operation to get this offer over $1 trillion. Now, it doesn't mean that banks are actually taking $1 trillion. It just means the Fed is offering a large number. And some people say they maybe just picked a large number for the shock factor to say, we're here, we're trying to provide the market with confidence. But the problem here is that the Fed does not have the authority or the ability to localize its stimulus to wherever we're seeing the concentration of coronavirus cases. More importantly, the Fed is a monetary institution, and it cannot address the health implications of what is a health first crisis. So the numbers of coronavirus cases, which, by the way, this was put together this morning, so it's possible that these numbers are outdated, but it's only ramped up. And the problem is that businesses are starting to consider maybe closing their doors. So from the slides I showed you earlier, there's a question about what this is going to do to Main Street, to people having jobs. So yes, markets are selling off, but what's more important is that it reflects a real concern over the impact of this whole thing to the U.S. economy and, more importantly, to the U.S. worker. Now, ultimately, attention is going to turn to the White House and Congress to create a fiscal plan that could more easily and more targeted address the problems on Main Street for those workers that might be in the crosshair of this whole thing.
And we've also, one of the things they did announce is the Small Business Administration.
Small business loans,
the $50 billion, although from those numbers that you were showing us at the beginning,
might not be enough.
Not enough.
Yeah.
All right.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.